This is $100. Imagine a family member walked up to you and asked to borrow $100 with the promise that they will pay it back, of course. Now, instead, imagine you own one of the world's largest banks, receiving hundreds of applicants per day requesting that you let them borrow money. It is very likely you'll be much more hesitant to let just about anyone borrow money, because as the bank, you not only want to let someone borrow money, but you also need to make sure that you can also turn a profit on that money while minimizing risk. And this is where credit score comes into play, because every time someone submits an application to open a line of credit or get approved for a loan, lenders and banks will look at your score in order to determine whether you are financially responsible. But with all the information out there about credit, how much of it is fluff and how much of it is actually actionable advice?
Company behind FICO, the country's most widely used credit score.
Credit cards can affect your finances for years.
Nearly 100 million Americans suffer from poor credit.
So every lender is going to have their own secret sauce for how they make loans.
So your credit score is really just a report card of how well you handle your money.
Credit is essentially the ability to borrow money from lenders and creditors with the understanding that you will pay it back at a later time and date. Your credit score determines your eligibility to borrow money, interest rates on that money, and as well as if you get approved to borrow money in the first place. A lender or a creditor is essentially a person, business, or organization that lends money to someone, and the person who is borrowing that money is referred to as the borrower. In the US, there are 3 main credit reporting agencies that most lenders and creditors look at when it comes to checking your credit score. The first being TransUnion, established in 1968, the second being Equifax, established in 1899, and the third being Experian, established in 1996. These 3 credit bureaus compile reports and data about a certain individual and then package these reports into a number through their own scoring system. The way these bureaus are able to identify your identity is through your name, address, social security number, and as well as your date of birth. It is through these identification factors that anytime you open a new line of credit or open a credit card account, they will require these pieces of information in order to see who the debt belongs to. There are 2 main scoring models that are most commonly used in the industry. The 2 most common being your FICO score and as well as your Vantage score. For simplicity, I'll only be covering FICO in this video. Your FICO score ranges from the low 300 and can go as high as 850. This could be the equivalent of a financial report card. These bureaus compile data such as payment history, credit mix, credit utilization, new accounts, and age of credit, and then through these factors, each bureau uses their own scoring model to determine your score. Additionally, since these bureaus don't actually communicate or share information with one another, your credit for each bureau may actually be different. For example, it's important to keep track of your score between each bureau before applying for a loan or a credit card. The reason why is because let's just say if you have a credit score of 650 with TransUnion, 635 with Equifax, and 600 with Experian. Certain creditors may only pull your credit from a certain bureau. Let's just say, for example, you applied for a credit card with X creditor, but this creditor only considers scores from Experian, and due to Experian being your lowest score, this can actually result in you getting a high interest rate on that line of credit or getting flat out denied, even if you have better credit with the other bureaus. So the question you might be asking, why do creditors care so much about your credit score? Imagine for a second you wanted to start a family. Your boss just granted you a promotion, the love of your life just said yes, and you're expecting a little one very soon. Life so far is looking promising. You decide that buying a home would be the next best step for you and your family. But in order to accommodate for your new purchase, it will require you to get some funding. You can either save up and wait till you have the funds from your promotion to help you purchase your new home, but that can take years and you're already expecting a little one very soon. Or you can use your existing good credit to try to get pre-approved for a mortgage. This is where you fill out a mortgage application in order to get approved for a loan to purchase your new home. And after getting pre-approved, you scout the neighborhoods, looking at open houses, attending showings, and after many sleepless nights, months of house hunting, you finally found the perfect place. You decide to purchase a home. Your credit score is the first thing lenders and creditors look at to determine whether or not they will let you borrow money. An individual with good credit is very likely to have more opportunities to borrow money with lower interest rates, higher credit limits, and very likely to have more purchasing power compared to an individual with bad credit, which are usually likely to have higher interest rates, lower credit limits, and typically a lot less buying power. Whenever you apply for a credit card, creditors are required by law to disclose the interest rate and the APR every time you borrow money. Interest rate is essentially the amount a lender charges in order to borrow money. Typically, this is expressed as a percentage amount and can vary based on your credit. Good credit has lower interest rates, bad credit typically has higher interest rates. APR is the annual percentage rate. It is the yearly rate of interest that an individual must pay on a loan. It ultimately discloses exactly what you'll be paying back on a loan each year and allows consumers to make better lending decisions when it comes to shopping for different loans or seeing what works best for them. For example, when it comes to funding a big purchase such as a car or a home, lenders will often pull your credit score and determine whether or not you are a trustworthy candidate to let you borrow money. Then, based on your credit score and other factors such as existing debt, monthly income, and current employment, the lender will determine the APR in the interest rate of that loan to the borrower. While credit is a big factor in a majority of these lending decisions, other factors such as existing debt, monthly income, and current employment also play a key role in every lending decision. Your credit score helps determine whether or not lenders will allow you to borrow money, and having a higher credit score gives lenders more trust and confidence that you are financially responsible. Your credit score is determined by a number of factors. The first being your payment history, which is self-explanatory but has one of the highest effects on your credit score. This factor accounts for about 35% of your total score, and essentially it's just a track record of whether or not you pay your bills on time. Making sure that you make your payments on time or that you have auto pay set up is crucial since this factors for about a majority of your credit score. The second one on this list is your credit utilization, which is essentially the amount of revolving credit that you have available. This number is found by adding your debt total and dividing it by your total available credit. The remaining number left over is your credit utilization rate. This factors for about 30% of your total score and comes in second after your payment history. The third being your credit age, which accounts for about 15% of your total credit score, and this is essentially the length of your credit history and how long your accounts have been open and active for. In general, a longer credit history will help increase your credit score, assuming that you keep every other factor in check as well. The fourth on this list is your credit mix. This is just a sum of the types of credit cards, loan, retail accounts, mortgage loans, or finance accounts that you have open. And usually having a variety of accounts helps lenders and creditors see that you have a history of borrowing money. This accounts for about 10% of your total FICO score. The fifth on this list is your new credit, which accounts for about 10% of your total score, but essentially just accounts for the number of credit card accounts that you tried to open in the past. For example, every time you apply for a new credit card, the creditor may issue what is called a hard pull. This is where they check your credit to determine your eligibility. This does in fact affect your credit score and can actually drop it by a few points, but keep in mind that even if you are not approved for this credit card, that it will still remain on your credit for up to 2 years. This is where new credit comes into play, as creditors and lenders just want to see if you have recently tried to open lines of credit or credit cards in the past. So as a rule of thumb, when opening credit card accounts, it's best not to apply for so many credit cards at once, as it can be deemed risky to some lenders, and the more you try to open, the more it will negatively affect your credit score, which ultimately leaves us with another question. What if you have bad or no credit at all? When it comes to credit, there are 3 categories that most people fall under. There are those with good credit, those with bad credit, and then those with no credit. This video is aimed towards those with no credit or a bad credit history. It is important to understand that regardless whether you have bad credit or no credit, building your credit score is something that does not happen overnight. And it's incredibly important that in almost every circumstance, having a long-term strategy will always be a short fix. Your main focus in personal finance should be to prioritize either creating more income streams, increasing your existing income, or decreasing unnecessary spending. If you can spend more time increasing your cash flow while reducing your expenses, this will inevitably allow you to have excess cash to pay off any existing debt. The goal here is not to have a perfect score, but rather understand where your income and expenses are on the ladder, and leverage credit as a tool to either build new streams of income, start a business, or even fund a major purchase. And if you have bad credit or no credit, there are a few major takeaways that you can use from this video. The first step in personal finance is to analyze your income and spending. Analyzing where your income comes from, whether a job, business, or passively, it's crucial in determining how much you are bringing in every single month before expenses. Then analyzing your spending habits and being able to recognize what expenses are reducing your income every single month. Unnecessary bills, canceling subscriptions, and decreased spending on outside food is a good start. If you're able to manage your money wisely prior to the use of credit, it can help build a good foundation to good money management without having to use credit or debt as a crutch to get by. The second step in your personal finance journey is to actively monitor your credit. The best thing you can do is to at least get your free credit report at annualcreditreport.com. US federal law allows you to at least get 1 free copy of your credit report every 12 months from each of the bureaus, so make sure to take advantage of that while it's still available. But since we know that credit monitoring should actively be done, then it's recommended that you check out other options as well. Additionally, bureaus such as Equifax, TransUnion, and Experian have their own credit reporting system, and I do believe they charge some sort of monthly fee. So just keep that in mind before you sign up. Additionally, keep in mind this video is not sponsored by any of the options I just listed, so please do your research prior to signing up, and this is in no way, shape, or form endorsing any sort of specific product. If you currently have no credit, then creating an account is still recommended, as many of these credit monitoring accounts, such as Credit Karma, make several recommendations on what credit cards would be best if you are just starting out. The third step is to understand exactly how to build good credit in the first place. There is a common misconception that credit is bad and that once you ruin your credit, it's impossible to get it back into good standing. These misconceptions are completely false. All the bureaus care about is whether you are financially responsible when it comes to borrowing and handling money. This means that every time you are borrowing money from your creditor, that you are not maxing out your lines of credit near the credit limit. Additionally, when you do have a balance, you at least make a minimum payment towards your balance every single month. That way your creditor or lender reports it as an on-time payment. As a general rule of thumb, keeping your credit utilization under 30% is recommended if you want to have a healthy credit score. This means if you have a total line of credit of $1,000, that you don't spend over $300 if you want to stay under that 30% credit utilization rate. It's as simple as not overspending and always paying back what you owe on time. Hey everyone, thank you guys so much for watching today's video. This video is more about the basics of credit and how it works. If you live in the US, credit plays a critical role in the majority of lending decisions, and having good credit can help give you better and more opportunities than those without it. Since this video is just the bare bones basics, this does not cover credit hacks, types of credit cards, or how to open a business line of credit, which is a topic totally on its own aside from personal credit. But overall, this video is a good starting point if you just want to leverage credit, keep it in good standing, or if you're looking for some sort of financial direction. In my opinion, having financial success is the ability to fund or make any purchase and reasonably pay it back without having to exhaust your income. And if you can build good credit and keep it in good standing, then you will inevitably have more buying power in every negotiation, lending decision, and in every purchase. But with that said, guys, I hope you guys have a wonderful day. I hope you guys enjoyed it. If you guys did, make sure to smash that thumbs up button. Make sure to subscribe to the channel. I'll be dropping more videos just like this, and I'll see you guys in the next one. Peace.
Unaware of where my heart would flow, I was waiting in the undertow.